Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we are looking at Critical Metals Core, ticker CRML.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we really get going, I do want to mention there is a 14-day trial link for StockOracle in the description, along with our affiliate disclosure. Keep in mind that AI insights and value estimates can sometimes be wrong, so always verify the data yourself.
Right, and we're definitely going to need to verify some data today because this one is, it's a wild ride.
It really is. Usually when we're looking at wealth-building stocks, as someone who really prioritizes protecting capital, there is a fundamental baseline expectation. You expect a company to actually be making money.
Yeah, revenue is kind of the traditional prerequisite for, world domination. You generally have to sell something first.
Exactly. You picture a massive company with billions in free cash flow using that money to buy up global assets. But today, we are looking at the high-stakes world of critical minerals. And honestly, that traditional rulebook just gets thrown straight into the incinerator here.
It really does. CRML is attempting to assemble this sprawling mining empire across 3 different continents. They are dealing with multiple governments, crazy regulatory bodies, and they haven't generated a single dollar of commercial revenue yet.
Which terrifies me from a valuation perspective. But welcome to today's deep dive. Our mission is to unpack this highly volatile stock using a stack of fresh equity research, SEC filings, and market data, all current as of August 22, 2026.
And it is a fascinating setup. They are racing to secure the future of global supply chains, but they are fighting against this ticking financial clock of their own making.
Right. So whether you are tracking the global transition away from Chinese supply chains or you just want to see how a pre-revenue company survives the brutal math of the public markets, this is the perfect case study.
Because the macro narrative is just massive here. We are talking about a fundamental global shift in resources, which is a huge, long-term wealth-building thesis. But, a cool geopolitical narrative doesn't automatically pay the electric bill.
No, it does not. So let's start with the immediate catalyst, the thing that puts CRML on our radar this week. On August 21st, 2026, the shares just went on an absolute tear.
Yeah, a huge move.
They surged 22.6% in a single trading day, closing at $7.11. And a move that aggressive usually means something fundamental just shifted in the machinery.
It did. That spike was actually a direct reaction to a freshly amended SEC filing. So CRML is trying to acquire a company called European Lithium Ltd., and the news was a change in the terms of that exact acquisition.
Okay, break that down for us. What changed?
Well, they introduced what is called a floating share exchange ratio, specifically between 0.025 and 0.045. And they attached a cap and collar mechanism tied to the stock's volume-weighted average price, or VWAP.
Oh, wow.
Yeah, locking it into an $8 to $16 band on the NASDAQ.
Okay, I can literally hear people's eyes glazing over at the phrase floating share exchange ratio tied to a VWAP. So let's translate that. When you buy a company using stock instead of cash, you are basically using your stock as currency, right?
Exactly. You're printing your own currency to make the purchase. It's the core of an all-stock deal.
Right. So let's say I agree to buy your company for $1 million. My stock is trading at $10 a share, so I owe you 100,000 shares. But if my stock drops to $5 before the deal closes,
which is the big risk.
Yeah, with a floating ratio, I now have to hand over 200,000 shares to hit that $1 million valuation.
That is perfectly said. The dollar value is fixed, so the share count has to float up to make up the difference. If your stock crashes, you issue a massive amount of new shares, which just relentlessly dilutes everyone who already owns the stock.
It destroys shareholder value. It is a death spiral. So that brings us to the VWAP, the volume-weighted average price. They aren't just looking at the closing price on a random Tuesday, are they?
No, and that is a really crucial protection. The VWAP calculates the average price over a period of time, but it weighs it based on trading volume.
So you can't just manipulate it.
Right. It prevents someone from dumping a few thousand shares right at the closing bell to artificially crash the price and force CRML to print more shares. It smooths out the math based on where the real money is actually moving.
Okay, so that leads to the cap and collar mechanism. If the floating ratio is dangerous because a crash forces endless dilution, the collar is like putting bumper rails on a bowling lane, right?
That is a great analogy. It acts as a strict boundary.
It dictates that they will adjust the shares, but only while the stock stays between that $8 and $16 band. So if the stock drops to $2, CRML isn't forced to issue 1 billion shares and wipe everybody out.
Exactly. The market was clearly terrified of this open-ended dilution risk hanging over the European lithium deal. By putting those bumper rails in place, they removed a massive cloud of uncertainty.
The downside was mathematically capped?
Yeah, and that sheer relief is exactly what sent the stock popping 22%.
Okay, so we know how they're trying to buy this company without destroying their own stock. But let's look at the actual business quality and their long-term growth drivers. Why is a company with zero revenue trying to buy an Austrian lithium mine anyway?
Well, the motivation ties into a huge macro tailwind. We are seeing a massive, urgent policy shift in Western economies to break dependence on Chinese supply chains for critical minerals.
The whole de-risking trend.
Right. Things like lithium, rare earths, niobium. These are the building blocks of the modern economy. EVs, energy grids, defense tech. Western governments are practically begging for supply chains aligned with their own interests.
And CRML wants to be the answer to that. But let's look at their master plan because it is intensely ambitious. They're building a 3-pillar portfolio across 3 different jurisdictions.
The existing and emerging engines of their business model, basically.
Right. Let's walk through it. Pillar 1 is in Greenland, right?
Yep, the Tanbreeze project. It's a rare earth asset. And on the exact same day the stock popped, the CEO, Tony Sage, reaffirmed their target for initial production by 2029.
Okay, so 2029 for Greenland. Then Pillar 2 is the European lithium deal in Austria, the Wolfsburg lithium project. They want to close that acquisition in October 2026.
That is the near-term catalyst. And then the third pillar, which I see as massive optionality, is in Kenya, the Marima Hill project.
That's one with rare earths and niobium, right?
Exactly. And CRML just advanced as one of 3 finalist bidders in a government tender process for that site.
Okay, I have to pause here. I really have to challenge the fundamental logic of this. Because from an execution standpoint, this looks like a terrifying game of global risk.
It's definitely complicated.
I mean, they have zero commercial revenue, no cash flow. And they are trying to manage environmental permitting in the Arctic, close a complex corporate merger in the EU, and win a government tender in Africa simultaneously.
Yeah, it's a lot of spinning plates.
Is that brilliant diversification? Or is it just spreading yourself so thin that nothing actually gets built? Shouldn't a pre-revenue company focus every single dollar on getting just one mine producing cash?
Look, your skepticism is totally fair. It is the exact debate institutional investors are having right now. Pre-revenue mining is notoriously hard, even if the mine is in your own backyard.
Let alone 3 different continents.
Exactly. 3 geologies, 3 regulatory environments, 3 political dynamics. But we really have to look at the upside here, the growth-driven thesis. If they pull this off, the payoff is absolutely transformative.
Okay, walk me through that. Why take on this much complexity?
Because if CRML closes the Austrian deal, wins the Kenya tender, and keeps Greenland on track, their corporate identity completely re-rates. They go from being a speculative exploration shell to a multi-commodity development stage producer.
Which is exactly what Western capital is hunting for.
Yes. Institutional investors and government grant programs don't really want to back one isolated mine. They want diversified platforms. If CRML executes this juggle, they become a strategic Western supply chain platform, and the valuation multiples for platforms are vastly higher.
So they're basically building a narrative designed to make themselves too strategically important to fail. They want to be irresistible to Western capital.
That is the ambition. But the problem, and you pointed this out earlier, is that ambition requires an enormous amount of capital.
Right. So let's pivot to the valuation and the financial reality check. Because the numbers on their balance sheet are, well, they're a bit contradictory.
Contradictions are usually where the real story is. What stands out to you?
Looking at the fiscal year ending June 2025, their total assets grew from $59.3 million to $171.7 million.
That's a huge jump.
And their stockholders' equity flipped from negative $11 million to a positive $91.9 million. If you just glance at those 2 lines, it looks like explosive, highly profitable growth.
It does. It creates a very powerful illusion of wealth. But this is mining. We have to separate paper valuations from actual spendable liquidity.
Right. You can't pay your contractors with rocks that are still in the ground.
Exactly. That asset growth reflects capitalized exploration costs and mineral rights revaluations. It is an accounting rule, not cash in the bank.
Which leads directly to what could go wrong, the liquidity crisis. They are pre-production, zero revenue. At the end of June 2025, they had roughly $7.3 million in actual cash.
And what was their burn rate?
Their operating cash outflow for that year was roughly $14.5 million.
Wow. So they are burning through capital at twice the rate of their available cash reserves.
Yes. Now, I should note their net loss did narrow. It dropped almost 63%, down from 139.4 million in 2024 to 51.8 million in 2025.
That's an improvement, but it doesn't solve the immediate math.
Not at all. 7.3 million in the bank, burning 14.5 million a year just to keep the lights on. That gap is the giant elephant in the room. They are going to have to raise money. There is no way around it.
And raising money right now is incredibly painful for current shareholders. This is where we get into the real threat to long-term wealth building dilution.
Right. A year ago, this stock was at a 52-week high of $32.15. Today, even after that 22% surge, it is sitting at $7.11.
That is a 77.9% drop.
Yeah. And when your stock price is your primary currency, a drop like that destroys your purchasing power.
It really does.
Think of dilution like a pizza. When the stock was at $32, raising $20 million meant slicing off a tiny sliver of the corporate pizza for new investors. Existing shareholders kept most of the pie.
But down at $7.
Yeah, at $7, raising that same $20 million means giving away half the entire pizza. The founders and retail investors are left holding absolute crumbs.
The mechanical reality is every time they go to the market to survive, until that 2029 Greenland target, they have to issue way more shares than they used to. The market knows this, which is why the technicals and sentiment are so rough.
Let's do that technical and sentiment check right now. Despite the recent surge, which was a 39% bounce from its low of $5.11, it is still struggling.
Where are the moving averages?
At $7.11, it is well below its 50-day moving average of $7.71. And it's miles below the 200-day moving average of $9.82.
Yeah, from a technical standpoint, being below both of those means the long-term trend is still firmly pointed downward. The recent pop was just relief over the cap and collar. The broader market is still deeply skeptical.
And the insiders seem a bit skeptical too. We pulled the MSPR data, the monthly sentiment price ratio. For CRML, as of August 2026, it is sitting at negative 100.
Ouch. And just to clarify for everyone, the MSPR is an oscillator gauge from negative 100 to positive 100. It tracks open market buying and selling by corporate insiders.
So a negative 100 means absolutely zero open market buying from the executives and the board, right? Nobody is writing a personal check for these shares.
That is exactly what it implies. Now, it's not super uncommon for executives at early-stage miners to hold off on buying, since they already have tons of founder shares and options.
Right.
But still, a negative 100 does not project confidence to the public.
No, it doesn't. So when we look at the 3 to 5 year blue sky scenario, what does that actually look like if management executes perfectly?
The blue sky scenario is that they close the Austrian acquisition, secure the Kenya asset, and fund Greenland to production without destroying the share structure.
If they do that, what happens?
They completely re-rate. They become the premier Western-aligned critical minerals platform. We're talking about supplying lithium, niobium, and rare earths to a market absolutely desperate for them.
So immense long-term growth and durable cash flow if they reach that point.
Exactly. It's wildly optimistic and not a prediction, but that is what the business could become in 3 to 5 years.
Okay, let's bring it down to earth and give our wealth building verdict based on the August 2026 data. What is the base case and the overall investment rating?
Synthesizing everything. The massive geopolitical tailwind against the $7 million in cash, the huge burn rate, and the devastated stock price. My rating is a 5 out of 10, a pure neutral rating.
A 5 out of 10. So the market has priced in the execution risk.
Right. The base case doesn't mean failure. It means CRML likely closes the European lithium deal and pushes forward. But to survive until 2029, they will need multiple highly dilutive capital raises. They'll probably reach the finish line, but getting there will cost current shareholders a lot of equity.
So summarizing the whole picture, the strongest long-term driver is definitely the macro geopolitical shift away from China. The biggest threat is cash burn and massive share dilution.
Yep, that sums it up perfectly.
The base case is survival but heavy dilution, and the blue sky case is becoming a multi-continent critical minerals powerhouse. Overall, a 5 out of 10 rating.
It really is the ultimate case study. A great narrative doesn't make you immune to basic corporate math. If your bank account hits zero, the free market will punish you.
But that brings me to a really provocative closing thought for you all to ponder. The near-term horizon is October 2026. That is the deadline for the European lithium deal.
A huge binary event.
Right. If it fails, they shrink back to a single project company in Greenland with under $8 million in cash. But looking beyond that, as Western governments become truly desperate to secure these supply chains for national defense, are we approaching a point where these pre-revenue mining companies don't actually need the free market?
Oh, that is a fascinating question.
Right. Well, strategic government grants and sovereign wealth funds just oversee the normal rules of financial fundamentals. If a country needs lithium to survive, maybe a $14 million burn rate just doesn't matter to a government money printer. Something to think about as October approaches.
It definitely changes the whole risk profile if governments step in to backstop these companies.
It really does. Well, that wraps up our analysis on CRML. Just a reminder, if you want to run your own scenarios, check out the 14-day trial link for StockOracle in the description, and be sure to read our affiliate disclosure.
Always do your own research and verify those value estimates.
Thanks for joining us on this deep dive. We'll see you next time.